And all of a sudden, this is not working because they're kind of like, yeah, what, me worry? I'm not worried. Who's worried? The U.S. consumer is worried. And that's the problem here for Trump because, man, I'll tell you what, the consumer is really struggling here. And that comes back to me. And that comes back to what that'll be the catalyst for the Fed. And that'll be the catalyst for the next move down in the dollar that's really tangible. And once the dollar broke 99.65, it's got 89 written all over it. There is like nothing in terms of technical support all that way, and that will give you enough dollar decline to really spark the commodities. But what makes that interesting? What does that do? It brings inflation back.
This is Little by Little with Andy Schechtman.
Well, here we are again. Welcome back, everybody, to another episode of Little by Little. The guests keep getting better. I'm honored today to have someone who Peter Grandich introduced me to, a very good guy and fellow Floridian, Greg Weldon. And Greg, I was looking at your impressive resume. I'll read just a little bit about it here. One of the things I'm interested in, or I always find interesting, is someone who began their career in the COMEX gold and silver pits. Would have loved to have been there and see what the open outcry system is like. The market where you settle things with a handshake or I suppose a fist if it goes the wrong way, way back when.
But there's a lot of both of those for sure.
I bet. I would have loved to have seen it. But before moving into institutional brokerage business at Lehman and Prudential, then proprietary trading at More Capital and Commodity Corporation. Today, he publishes the Global Macro Strategy Report, which deploys the same methodology, regiment, and approach that evidently you take towards managing your client money as a CTA. All this can be found on Weldon Online. Greg, welcome in. Thanks for coming, brother. It's nice to see you.
My pleasure. I feel honored to be on your
likewise.
show.
No, I feel honored. And look, let me jump right into it. Getting to know you a little bit and reading about your past, it seems obvious that you've been around the block. You've been navigating global markets for over 4 decades. You've traded through rate shocks, recessions, booms, bubbles. You've seen it all. So let me start here. What feels different about this moment in the cycle compared to everything you've seen before?
Well, I mean, that's a great question. And it takes you all the way back to World Trade Center. And when I started at Florida Commodities Exchange, and you talk about that and you say, you wish you could be there. What's interesting about that is kind of quick background is they filmed Trading Places there, right? And they did that while I was working there. And they had a lottery of all the people that worked there to see who would be the extras in all the trading scenes at the end, right? So they did it over a weekend. And it was funny. And they did it in the gold and silver pits. And if you remember the one scene where they carried the trader out from Duke and Duke, that's actually John Hanneman, who was the chairman of the exchange at the time. And that was the gold pit right there. And where they carried him out was right where I started working. And of course, the short story is that I got this job simply because of my height. I was visiting a friend of mine, and I'm 6'10". I used to play college basketball. I was actually on my way to play basketball in Europe at the time. And I started talking to this guy, and I fell in love with the place. I was just taking my friend out, for his birthday, a high school buddy who was working down there. And we're walking off the floor, and, he had brought me down while they were trading. I was just like amazed, like, how do you understand what's happening here? I mean, it's complete chaos. And as I'm walking off, I say, man, is anyone you can give me a job here? I'd love to work here. How do you get started on this kind of thing? He goes, that guy who just asked you about playing basketball owns the largest firm on the floor. So I did a face plant, foot plant, turned around and went back and asked them for a job, and they hired me simply because I could hand paper over heads and see to the back of the booth and know the hand signals, which of course I knew nothing. It was total trial by fire. I had no idea. And I remember the first question I asked was, what holds up the price of gold? And so, it's been 40 years of, watching that play out in terms of how it's valued. But the bigger point to your question, which is a perfect question for right now, is that I have seen the entire 40-year downtrend in inflation and interest rates. And it comes off Paul Volcker defeating inflation, early 80s, 81, 82, right? Then you had the Plaza Accord, which brought the dollar down, 85. I remember that day distinctly riding the train in that Monday morning after Sunday night. They had agreed to get the dollar lower, right? And that was just a boon to everything. Led to the 87 crash. But I mean, you see 1990, 97, you had the Asian, Brazilian, Russian FX debt crisis. You had 98 long-term capital management. 2000 was the tech bubble crash, then 2007 and 8. I wrote about that in my book in 2006. I've seen every part of this long cycle that was 40 years where, yes, buy and hold equities and you'll do fine. The problem is now you have had this whole thing where you took rates down below zero. You learned that that's not going to work, that sends the wrong message. You're telling the people we don't believe the things that we good enough that we're not going to raise interest rate for 2 years. That's just going to cause a consumer cocoon, which is how it played out in Europe. So when you look at now we have the physical limits of what policy can do outside of QE. QE is now the policy, but in this whole 40-year thing, when you go back and it's like you want to liken Trump to some kind of revolution of the American spirit type of thing, and I'd love to believe that could be true. The problem is Reagan in 80 had no debt. This is how we treated the Russians. We outspent them on all this defense and stuff, right? So this is the huge thing now, and I have said one of my themes for this year is crossing the event horizon, that we have crossed what I call the macro event horizon. We've entered a debt black hole. You are now to the point where debt is higher than GDP, where even when you look at the consumer, personal spending is higher than personal disposable income on a month-to-month basis. You have credit card debt is higher than personal savings, nominally higher. So these are things where you say, you are in this dynamic where they will have to ease, they will have to print more money down the road because the 40-year trend is over. It's now the other way because of debt, meaning higher interest rates, higher highs, higher lows, and higher inflation because they have to print more money now. It is the only means they have left to really stimulate the economy. And what we see right now is a consumer that is cocooning, really, and that cocoon is hardening very quickly. Just some of the data, even on online sales, for example, just came out, retail sales last week. Since last September, right, last 6 months, online sales are up barely 2 billion, which is basically at an annualized rate over the last 6 months is less than 0.5% growth. That does not include inflation, which even if inflation is 2.8, PCE core 2.8, that still means you're talking about real online retail sales that are deflating at nearly a 3% rate. So this is where the consumer is with credit card debt, it's maxed out, borrowed at the highest rates ever. And you have now delinquency rates looking like 2008, right before the financial market, kind of went belly up as well. So there's a lot of similarities, and having seen this entire cycle time and time again, understanding back in 2007, they would have to do what everyone considered monetary blasphemy, which was monetize government debt. And so when you talk about having household debt of 18 trillion, government debt of 36 trillion, on top of, GDP that isn't even 30 trillion, that's your debt black hole right there. You've crossed the horizon line.
What about the unfunded liabilities? How does that factor into the debt black hole?
Oh, it factors in to tell you if you think there's any ambiguity about this, that that once you look at the real picture, that it's, severe, that you would expect that at some point, if you want to keep this analogy going, and I'm an astrophysics guy, I love it. When you talk about where you get to the point where the gravitational pull actually rips you apart, and it's kind of like, is the consumer, how close is maybe the consumer to that? And this whole dynamic in the stock market, if you recall, I think we had spoken about this, and certainly on Peter's show, about what we envisioned coming this year, back in January, which would be an economic reality check in the stock market, where you would run the course in AI, that it was played out as far as we're going to go. What's left to be leadership? It certainly wasn't a consumer. If you look at like the XLY, which is a consumer discretionary, the XRT, consumer retailer, or I like the PNQI, which is the internet retailer ETF. These things have been projecting 30% declines in the stock market for like the last 6 months. So to me, there's a much more complicated picture here when you start talking about the Fed, let alone Trump, let alone tariffs, let alone China, and a lot of other things, as you know.
Shit, man, all this intellect you have, a 6'10" basketball player who traded on the floor and astrophysics. I didn't see that in your bio. Very impressive, to say the least. I think that's fascinating way of looking at things, and very logical, the way that you broke it down. And Right. An economy that consumes more than it produces and is very much indebted. It seems like the Fed might be out of options. And along that line, do you think the Fed is still in control, or are we entering a phase where monetary policy no longer works the way it used to?
Yeah, I'd say no and yes. I mean, they're not out of control because, and I wrote this in my book in 2006. I mean, the long-term trend, where this will ultimately go. All right, and you see it little by little happening. There's no doubt the evidence is there now. We're leaving a paper trail of this. Is what I call monetary Armageddon. We got the Treasury guy and the Fed chief in the bunker, in the monetary bunker, where they got to turn the key simultaneously and print enough money to buy every bond they ever sold. So, they think that that's not feasible. What's funny is you had a few years back that there was this thought process around, what was it, the TMM or TTM, the new monetary theory, where that would be okay, right? It's like, sure, that'd be okay, except, loaf of bread costs $75. All right. So that's where we're going, and it's inevitable. And you say, so to me, that's where the big trade this year has now begun to unfold once the stock market came off, and tariffs are the catalyst. They're not the cause. This would have happened in some other machination, no matter what. We would have had a catalyst for this. It just so happens to be tariffs. Well, the worst possible tariffs, catalyst you can want to throw in here, like a more of a explosive type of catalyst. But the bottom line here is that the way out is to print more money, and that's ultimately what they'll do. And we'll see how the Fed goes. And I also said that you have stagflation, all right, which I've been talking about for months, and you see it now in every statistic. And then you start to say, well, at some point, especially with inflation expectations, the numbers we just got out of the University of Michigan were shocking. The numbers we just got out of the household survey from the New York Fed were shocking. In terms of, inflation expectations up and income expectations the lowest in like 14 years. And there again, that dynamic between the two is, and especially if you look at their dispersion index, where they give you the range of answers, there are people that are telling the Fed, households saying to the Fed, we expect our real income will decline by 6 to 7% in the next 12 months. That's one of the responses in this survey. So when you really kind of start to think about that, they will have to acquiesce to the higher inflation to save the consumer. And what I was saying before, to get to the very end of this, is what creates the biggest trade here, which is a lower dollar, and then all the tangent trades that come off of that, which we're starting to see some of the commodities markets perk up even today.
I think you're reading my script here, and it's funny because Powell just came out and said, yeah, we may need to abandon our dual mandate, which I interpreted exactly the way you just said, let inflation go, that they can't do both. And my next question to you was verbatim, with soaring debt, stubborn inflation, and slowing growth, are we already in the early stages of global stagflation cycle? How do you see it playing out from here? You kind of answered that. Anything you'd like to add to that?
Yeah, absolutely. I mean, you see it in all the other economies too, particularly in Europe. I mean, you can really pick your places in Europe. And certainly there have been places where, inflation has come down. And what I find here, I'm going to shift that question a little bit to, in terms of, let's look at the currency market. So we're thinking lower dollar. How can we put what you just asked me into play to help us with our currency selections if we want to play it, in a currency play? And I like to play currency play, metal play, commodity play. I want to play it all the way. But in that case, what you're seeing is some of the currencies that are more linked to Russia, that currencies that don't have really much trade with the U.S. And I mean, geographically, in terms of Poland and Hungary and the Czech Republic, these currencies in particular have been very strong. It also dates back to the fact that they had really high inflation. All right, they were directly impacted by the whole oil gas situation with Russia, where the central banks had to be really dramatic in their hiking of rates to like double-digit rates. A place like Poland had like 16% inflation, 12% interest rate. And as a result of that, when inflation came down, they were able to aggressively stimulate. And a place like Poland, the economy is kind of on fire, right? Especially if you have an end or a cessation of this war. So these are places where the currencies are breaking out against the dollar. There's not a lot of currencies out there that I really like. I think there's better ways in the commodities, and certainly gold has been the way. But I think there's going to be good currency plays here too, such as what I'm talking about. Another place would be, for example, Sweden. Doesn't have a lot of trade with the U.S. They're not really threatened by the U.S. And here's a currency where, it's still kind of, relatively speaking, in a no yield world, it's a high yield currency. So where it's breaking out against the dollar as well. So applying all of that. And I would say too, Canada, just did a piece yesterday on Canada. I think Canadian dollar is well positioned here because you had this whole liberal dynamic that really suppressed it politically. Then you had a little mini crisis meltdown with Trudeau, and you've had this back and forth on the trade war and potential tariffs. When you wipe that all away, if you say the Canadian dollar below 68 cents to the dollar to the US has priced all of that in, which I think it has, and the technicals suggest it has, it's so far undervalued relative to the commodities it exports, particularly crude oil. And that relationship gets restored a little bit. Canadian dollar could surprise on the upside, just to throw a trade out there.
Yeah, I remember when it was 1-to-1 not too many years ago. I was there for a softball tournament, so I was probably late 30s, early 40s, and it was at a 1-to-1 ratio. Speaking of gold, gold's breakout to me, Greg, really does feel different this time. Central banks are buying. The U.S. has become a net importer, and BRICS are settling trade in gold. Do you believe, let's not forget what Judy says. I had her on my show. Judy Shelton said Trump told her that he will issue gold-backed treasuries July 4th, 2026. That's what she said on my show, that they've discussed it for years. Some people think she'll be the next Federal Reserve chair. She was his nominee, of course, in 2016, although due to partisan politics, didn't get confirmed. She's an amazing lady. Do you think we're witnessing a quiet remonetization of gold, or is it something different?
Yeah, well, it's become less quiet, but I would say it's kind of been going on for a while. I mean, if you really look at it, gold has been appreciating against every currency on the planet for some time now. So I like to even flip it and say, if you take gold and just do a simple equation against the dollar index or any other currency, you're looking at really a relative purchasing power for that currency. So, the purchasing power of the dollar has been declining a lot for a while. Really, it's 20% plus now for months and months and months relative to gold. So to me, yeah, it's been quiet, but it's much less quiet now because people are getting it. And like you say, again, what to me, what really extends from that question is, yes, because central banks have been the accumulators of gold, even just as recently as the last month, China. I mean, so these are big numbers. And when you look at stuff like open interest on a commodities exchange, or when you look at something like the ETF ownership, and I actually want to ask you a question about the physical side of the market too. It seems to me, and certainly when you look at the mining shares, that you have not had this huge rotation of capital into these things yet to the degree that you could if you start really beginning to get the market to believe that the things that you're suggesting could happen, which of course they could happen. I mean, there's no doubt in this mindset and this era that something like that could easily happen. And again, BRICS, to me, I thank you for kind of introducing me to actually how this works, which is the only reason it makes any sense, is because of how exquisitely it's been put together. And so from this perspective, having the blockchain and being able to specify the different amounts of currencies between Thailand and Vietnam, if they're doing a trade, is brilliant, right? So I believe that, especially with Trump and tariffs, what does it do? It pushes people away from the dollar. It's like you want to say you're going to do this and keep the dollar strong, and then you do something like this, which only makes it more urgent that all these countries that want to do this. So if you don't think, you would know more than I would even, the back rooms are buzzing right now to get this done as soon as possible. And, it's increasingly showing up in signs of things being, settled in gold in terms of oil trade, for example. So, yeah, I think all that. But to me, when you talk about investors out there outside of the physical gold world, that the mining shares now have just broken out. It took a long time before the mining shares were willing to believe, or investors were willing to believe, that this fat, and I'd say PHAT margin right now in gold miners, and Peter Grandage said it best, they're printing money. I mean, so from that perspective, at some point the GDX was going to break out. And it's only just now even broken out, even though we've been pushing it now kind of all year. And to the degree that the Canadian mining shares, because of the weakness of the Canadian dollar, so what we've done is, had the Canadian mining shares with the Canadian side of the risk side in the Canadian dollar hedged in the futures, and it's just been a beautiful play. So now the rest of the U.S. dollar comes down. Some of these other stocks beginning to show some upside oomph. Some of the big cap blue chip kind of behemoths that have not performed. It really has been on the periphery. And now you're seeing it outperforming even gold. The GDX is now up 2% against the underlying gold price of gold. over the last 52 weeks. But when you compare either gold or the GDX to the S&P, or more importantly, like to the NASDAQ or the XLK Infotech, the numbers are 45 to 60% outperformance over the last 52 weeks. And it's barely just starting in my mind, because you don't see the big Wall Street mutual fund, family office, global wealth manager money coming in yet. And when that gets going, this market is it's pretty shallow to the degree of the amount of money. You say, look, you should have 5% of your portfolio in gold. You think U.S. investors have 5% of their portfolio in gold? Not even close.
Rick Rule just only 1/2%.
Yeah, if we get it to 2 or 3, that would be a huge increase. So that kind of thing is real. And when you say what's different is, I remember sitting around, I was for a short stint when I was just after leaving, before I was working in the hedge fund, was also a broker at Prudential. And John Fallon, I don't know if you know that name, but he was one of the great gold brokers back in the day. He went to Colgate, where I went to Colgate. And he was running the bullion desk. I became very tight with him because I had been in the COMEX. And so I just remember a lot of times sitting around after a Friday, happy hour, sitting at the desk, having a cocktail at the bullion desk, and thinking about what would happen if you saw this kind of scenario that we're seeing now. And we're talking, this is like 1990. What would happen if you had 5% of wealth come into gold? The market wouldn't be able to handle it. It would be explosive. So I keep that in mind. And one of the things, being a CTA and watching markets now like cocoa, which traded to $12,000 a ton last year, it was a beautiful opportunity. But you can never rule out something outrageous happening. You can't put limits on the kind of moves that might happen. And I think that is really what's different here and applicable, and for so many other reasons, but, all kind of coming back to not only the central bank dynamic, where more printing, more money, more debasement of debt, more debasement of currencies, but also some of the physical things happening on the planet, which is also longer term.
Yeah, the Chinese just came out with their cross-border payment. It is the bridge, and they've connected it with 11 of the, I think it's 10 of the ASEAN countries. They're the Southeast Asian countries, along with 6 Middle Eastern nations. It's 40% of GDP. And this new system sidesteps SWIFT, and clearing time, which was normally 3 to 5 days with SWIFT and intermediary banks, is now down to 7 seconds. And what's very interesting, I think, which would add fuel to what you're saying, is what the Russian finance minister just came out the other day and said, in preparation for the Brazil BRICS summit here in just a month or two. Sergei Lavrov, and to me, this is something that the people who have been poo-pooing BRICS are not prepared to hear, and no one's talking about it, but to me, it expands greatly what you just said. And he came out and he said, this system would be independent of SWIFT, the US dollar, the euro, and the British pound. And Russian Foreign Minister Sergei Lavrov emphasized it will be open to non-member nations as well, accelerating de-dollarization on a global scale. So they're not just saying this is for the BRICS. They're all ISO 2022 compliant, all these cross-border payment central bank digital currencies, I guess you call them. They all speak to the same bridge technology. So they trade in local currencies outside of SWIFT and settle the imbalances in gold. These are the kind of things that
Now, is this a thing where these, like with where the BRICS countries, were importing the gold, and one of the reasons you saw a lot of physical gold movement? So does this include the non-members who would still need to have some backing of gold, though? Yes?
Yes, absolutely. So that they can at least settle the imbalances, whether it be currency or trade imbalances, settled in gold. Vietnam, you mentioned, they just became the 44th country to express interest in formally applying.
It's funny because, again, you kind of look back and, when 2018, when Shanghai opened a crude oil futures market based in renminbi, trading to Dubai OPEC grade crude, and got Russia to benchmark the Urals crude to that, it was like, come on, it's the beginning of the end. It was such a clear sign, and it progressed through to when Biden refused to go to the Olympics in China. Putin goes. And what happens? He walks away with a 30 trillion renminbi loan to build a new pipeline from Siberia to China for crude oil. They engaged Kazakhstan to get natural gas shipping, and all of a sudden now they're shutting down 5% of natural gas to Europe. This was all in a Chinese state bank financed in renminbi dynamic of 30 trillion renminbi. And it's like, do we see what's happening here? And now all of a sudden you have China and OPEC and Russia kind of aligned. You have Russia invading the Ukraine. Why? Because it's food, right? Now they have Crimea was the first move. Why? Because you have a port where you can ship it to where? To China. I mean, this is like a world war that's been going on since, in my mind, 2018, and it's a commodity, natural resource world war. The U.S., when they went after central bank assets from Russia, made it an asset war as well, and now we're vulnerable. It's like, hey, we're going to be a bully here. We're the world's largest debtor nation. So what this does is it further solidifies what I've been calling now since 2020, that side of the world versus this side of the world. And when you talk about that side of the world, and China is now talking to Japan and Korea on trade, I mean, hello, are we not seeing what's happening? The EU calls China. I mean, so to me, it was like, I'm not sure how the catalyst would be for the European side and UK to kind of fall into the other side of the world thing controlled by this new axis of power, OPEC, Russia, and China. But it was interesting to me, even that you see how the UK politically is kind of going now in terms of free speech and some of this stuff. It really is mind-blowing. So anything can happen here. And I see this as something that is more inevitable. And I think that I'll tell you what, I'm glad Trump may be softening a little bit. This is because here's what's really interesting. Trump is trying to bully two sides, trying to bully China, trying to bully the Fed. And what happens? Neither one of them, they're like, I just did this piece. It's what? Me worry? Do you remember, Mad
Alfred E.
Magazine?
Newman.
Oh my God, Alfred E. Newman, right? And it's like he's just a kind of a goofy dude who just doesn't really care about anything. And this was Xi, kind of like, look, our economy is not that bad outside the property market. Yes, a mess, but there's a lot of not bad things going on in the Chinese economy. You break down the data, which I did this week. It's not horrible. They can kind of wait. Their stock market's not cratering at all. It's actually kind of breaking out against the U.S. on a relative basis, mostly because the U.S. is down, but nonetheless, it's holding. And when you look at Powell, he's kind of like, yeah, I can wait too. And all of a sudden, this is not working because they're kind of like, yeah, what, me worry? I'm not worried. Who's worried? The U.S. consumer is worried. And that's the problem here for Trump because, man, I'll tell you what, the consumer is really struggling here. And that comes back to me. And that comes back to what that'll be the catalyst for the Fed. And that'll be the catalyst for the next move down in the dollar that's really tangible. And once the dollar broke 99.65, it's got 89 written all over it. There is like nothing in terms of technical support all that way. And that will give you enough dollar decline to really spark the commodities. But what makes that interesting? What does that do? It brings inflation back. We've already seen food on the rise. And some of these food commodities are very well positioned on their own merits from a fundamental situation to appreciate. So there's a lot going on there on the back end on the acquiescing to inflation side as well.
I hope my listeners see how bright you are and how you're able to connect the dots. I love the macro mind that you have, and I hope you get a lot of people signing up for what you're talking about. You have a really elegant, succinct, and easy to follow way about you, and it's interesting listening to you say this stuff. You've talked a lot about the importance of capital flows. What shifts are you seeing right now beneath the surface, and what are they telling you about where the smart money is going?
That's not coming here. I mean, I think it's pretty obvious, and it fits in with this entire thing. You're driving people away from the dollar. So when you see a day where the dollar's down, bonds are down, the stocks are down, that's a pretty telltale sign that foreigners are selling U.S. assets. And what's interesting is, within the context of the BRICS, if you want to take a country like Brazil, all right, they got a lot of dollars in reserves. So the extent to which they may be having to sell some of their treasuries and taking those dollars and buying gold, that too could be a problem. I know we got the blower here in the background all of a sudden.
Don't hear it. Don't hear it at all.
This is why it's like I can put all these dots together because I'm in my cave here 18 hours a day, busting ass. Like I'm not smarter than everyone. I work harder. But at any rate, Yeah, I forget where we were going with that. He distracted me. Sorry
We
about
were
that.
talking. That's okay. And I didn't hear anything. We were talking about capital flows, where you see them going,
Yeah.
where the smart money is going.
Yeah, I mean, the smart money really in Asia. I mean, again, if you look at some of the stronger currencies, you want to say where's stability in terms of currencies outside of what you would say about gold or what you might want to say about crypto as well. Let's not forget that would be, like Singapore dollar. I mean, even the Thai baht to some extent too. So you start to look at where do you see some currency stability in places like that, but you also see it in the periphery along places that are close to Russia and Ukraine. Because honestly, if there's going to be tighter relationships in trade and in cooperation among all these areas, you would think that those that would be kind of maybe moving away from the euro and to whatever extent from the dollar as well. The euro would be moving away from the dollar too. So on the periphery, those currencies would stand to benefit. And right now we see that. Those are the currencies breaking out against the dollar. So to me, capital flows really are very telegraphed by the currency markets. So currency is traveling to the countries that don't have trade situations with the U.S. that have links to Russia and or China. It's really that simple.
I agree. 2 questions left for you, brother. What's a macro view you hold right now that goes completely against the mainstream consensus, but you're convinced you'll be proven right in the end?
It's a good question, and it's kind of the same as what's different because, we're actively raising the money. One of the things we're trying to do is help people because I feel that my macro stance that would go against the grain is that, passively index investing in the U.S. stock market is going to fail to keep pace with the debasement of the purchasing power of the currency going forward. And that's not something that you could have said for 40 years. So that is a difference. And that is not something I think that people generally realize yet is going to be a trend. All right. I would add to that there are periods now too, when I've seen them. I mean, I lived them when I started in the market. I mean, the stock market had been going sideways for years. I mean, literally. So you could go 3-4 years where the stock market really does nothing. It's up. It's kind of going sideways because yes, policy might be less effective the next time the Fed moves because they have to bring so much firepower now to get the same percentage effect on the underlying money supply on all these dynamics because we need the growth to service the debt. So when you start to think about that and the debt black hole and all these things, it is inevitable that they will use the currency, they will print money, they will debase the bond market. And in that sense, stocks will go up because the tightest correlation of anything is a lower dollar, higher stocks, higher dollar, lower stocks. And it's been interesting because I think that might be the thing that puts in a low here. Actually, just yesterday morning, covered my gold position, got out of my long gold position, we'd hold it forever, and covered my short equity index position. And I think it could be because the dollar might bounce here, but also because if you go forward when the dollar's decline, that will be bullish for stocks, but you won't keep pace. So for me, it's like, and so we're, talking to new investors and had this conversation. And I said this is why, what people that do what I do as a CTA will become more valuable because of the way we can operate in currencies, commodities, bond markets, all the stock indexes. We'd be long, short. It's, overnight liquidity. It's regulated futures contracts. And when you talk about how you can stay ahead is to be long stuff like food commodities. Well, right now, I mean, I think stuff like the soybean market, even cocoa at a very high price, coffee has been a big winner. So when you start to talk about putting together returns that will match kind of more where the currency depreciation and debasement is taking place, I think that people that do what I do and will have the experience that I have to have seen this whole thing. And so the guy says to me, he goes, man, you've been waiting 35 minutes, 40 minutes to tell me to use that line. And I said, I've been waiting 40 years to use these lines because it's really the difference now. And to me, I wholeheartedly believe that. And, it's all well and good that, I will expand my business and do whatever we're doing for me and for my kids and grandkids, because that's really what it's about for me now. But also almost a mission statement to try and help people because I think they're going to be shocked with the kind of degradation of returns that you're going to see in the equity market in particular, on a relative basis.
Right on. You're a fascinating guy, man, and I really do appreciate your insight. Last question for you. As we said at the very beginning, you've seen markets crash, you've seen them recover, you've seen systems bend, you've seen them reset. Through it all, what's the biggest lesson you've learned and what gives you hope for your kids, for your grandkids, as we look ahead? Because there's got to be something to look forward to at the end.
Well, those are two different things, I would say. First of all, I think the lesson is, to me, is never think you have it figured out. Okay.
Especially in the game of golf.
Yeah. Well, that's a whole different, for me, the game of golf has become 5:30 when the clock is moved, where I can go out and play 8 holes when there's no one else out there and have the beautiful nature of the golf course.
I'd love to play golf with you. I'd love to see a guy that's 6'10" swing a golf club. Be fun to watch.
Well, I use my 30-year-old steel-headed, steel-shafted Nike 3-wood off the tee, only because I can keep it in the fairway, and I still hit it maybe 265 with the 3-wood. So
without even swinging. Well, if you're ever down this way, I hope you'll look me up so we can do. Sorry to interrupt. I just had to throw that in. I've never seen someone your height play golf.
But yeah, it's just, to me, it's always keep your head down and grind. And, understanding that I've become so comfortable in my methodology. And what I'm finding is, here's a lesson that I'm learning is there's always a new lesson. And here's the new lesson: when you try and stay ahead of the curve with whatever's evolving, because everything's always evolving, it never stays the same, except for human nature. So when you overlay human nature into everything evolving, it's an interesting puzzle to try and put together. But the bottom line here is, always the hardest thing for me as a trader and when I was a hedge fund manager, getting out of profitable positions. The most single hardest, difficult decision. You're always going to leave money on the table. The question is, do you want to leave it coming down? Do you want to think you got out at a high point? And that's always been the hardest thing. I've always preferred to kind of use trailing stops and use a lot of math, because I'm a science and math geek. And you say about, playing basketball, if you look at me now, physically, you would never think I'm a science and math geek. But I remember I used to play hockey when I was a kid, right? So when I got to be 6'5", like in 8th grade, they come to me and go, you need to change to basketball. So I went out and played basketball. We played every sport back then, so it wasn't like they pigeonhole you now. But I just remember I made the freshman basketball team, which was not expected. And I remember the freshman coach, who was my homeroom teacher too, said to the head basketball coach, "Yeah, we got to get this kid Weldon, man. He's tall and everything, but he's pretty coordinated, because I played hockey." And I remember the head coach said to him, "Weldon, that kid would rather read a book than play basketball." And at the time, he was right. I was like a bookworm. But anyway, so to the extent of the instincts that I have developed by watching these types of moves over and over and over, and understanding the psychology of the movements and people wanting to get in or out. And so to me, what I have found is I'm using more instinct than ever to exit profitable positions, and knock on wood, it has really benefited me, as opposed to using any of the stop mechanisms I would have used. It's is it a little dangerous? Well, maybe, because it's a change in methodology, but it's a change that over the last 3 years has proven to be very advantageous, because it also allows me then to kind of get back in, and maybe I'll give a little bit of more away there, where, okay, I got out up here, but I'm getting back in up here. Well, that's okay, because I don't mind changing the narrative where it's like buy high, buy low, sell high. I like to buy high and sell higher, or sell low and sell lower. I want the market to prove itself. So I don't mind giving it that little bit of margin every so often within the move, as opposed to waiting for this giant down move like you might see here, where you're up like $600 in a short period of time. It's like the market could be down 250 any day. I don't want to give that much back. So I'm trying to kind of tighten it up a little bit. And I think that's where 40 years of watching this every day has really paid off in understanding some of the patterns that is human nature that repeat again and again in the markets, particularly in high stress times like this.
And what gives you hope as you look ahead?
A lot of spirituality. I think a lot of what's happening on the planet too is, a kind of a spiritual uplifting as well. So I like to do energy work. I do a lot of reading in that sphere too. And so for my kids, it is kind of about love. On the other hand, if you take the reality view of this, to me, this is more of a situation where we've spent all this money on all these different things, when this planet is deteriorating very quickly. And this is part of a bigger cycle. We've talked about this before, but it's really big picture stuff in terms of the solar system's orbit through the Milky Way. And when you talk about the next 4 to 6 to 800 years, the best course of action rather than green, clean, and all these things we're spending money on is really kind of space and propulsions and ability to cryogenics or speed or wormholes or whatever we can do. And this is why they've picked up the whole search for, the next Earth and Earth 2.0 and all this stuff. And the findings are amazing if you keep pace with some of this stuff. So to me, if you really want to give hope for the future for the grandkids, it's really kind of centered in around science. And so I hope that the U.S. keeps up with science, and I hope that what comes next doesn't degrade the whole process. And this is why I really hope that, it's more that the kind of the totalitarian types that take control of all the politics around the world where none of this even happens.
You are fascinating, brother. I really appreciate your insights, your candor. We're going to have to do this again. And I will have you back on.
Sure.
Love to see your take on things as they unfold throughout the year. And I just wish you the very best. And it's been a great hour, great 45 minutes here. And I definitely look forward to do it again. So you stay well. I do hope to tee it up with you someday. And until next time, I'll look forward to catching up with you.
Sure. It's my pleasure. And thank you for all the kind words. I feel truly humbled. I appreciate it.
You got it, brother. And they're well deserved. Thanks again, Greg.
Little by Little with Andy Schechtman.